So I was asked a question today about someone just asked me a random question about whether or not they should consider selling their shares in a stock called NIO. And so NIO is a company that it's a Chinese-owned company. And what I did was I thought about it and I said, well, of course, there's a number of thoughts that someone should have in terms of should they sell, should they, purchase more shares. There's a lot of things that go into this conversation and this question. I think the snapshot was taken from, I believe, yesterday. So anyway, so I'm not exactly sure what NEO is today, but you can see it was down, it looks like 15% roughly yesterday, but about 50%, 50%, I think year over year, from what this person was telling me. And I said, well, one framework I can give you to think about this from is what's referred to as the capital asset pricing model to figure out what your expected return should be on this asset, um, you know, at this point in time. And if that expected return is kind of in line with what you think it should be, um, you could hold on to it, purchase more shares, etc. Now, this is just want to put out that this is like one component to understanding or to answering the question in terms of should I keep this particular stock? Should I sell it? Um, Etc. And there are many other components to the question or to the answer, which include, right, your own personal risk tolerance, your personal asset situation. So, what assets do you already have, and what does your kind of portfolio look like? Um, your age, when are you going to need to consume those funds? Your original investment thesis, why did you invest in this in the first place, etc. So there's a lot of components to this, but I'm only going to look at one piece of the puzzle. And then maybe I'll make another video to look at some of the other aspects. So you have NEO, right? Their beta, when I took this, I think it was yesterday, was 2, which means that it's, you know, riskier than the average, than the market return. A beta of 1 would be that would basically say that your stock or had the same volatility as the market itself, right? It behaves kind of just like the market. Um, just to benchmark, I chose another company, Ford, just to benchmark, another kind of automotive company because NIO is an automotive company. Um, and Ford had a beta of a 1.38, right? So much lower beta, right? Which would indicate that the company is um, in a sense, less risky. It's an older company. It has more stable cash flows, has a very big built-in kind of customer base. And again, it's been around for, I think, a couple hundred years or 100 years or so. So just a much more stable company. And it's already at what they would refer to as like a steady state. So the risk of the individual company versus the market is going to be more similar or closer to market risk because the company itself is so well established. Okay, other components to this. So I just got two things called the betas, which is kind of the risk profile of the two companies versus what the market return is. Um, Another item we would need is the what they refer to as the risk-free rate. And the risk-free rate that I'm using is the 10-year Treasury rate. The 10-year Treasury rate currently is at 4.10%, and the reason why they call it the risk-free rate is because if you buy a government bond, 10-year Treasury note today, Treasury bond today, you can expect to get 4%, 4.1% return on that investment over the course of the duration you hold the investment, you hold that bond. And the chance that the US government does not repay you with that 4% on top of your investment is very low. It's nearly zero, right? Pending some catastrophic event like some kind of crazy natural disaster or a nuclear war, something crazy that happens where the government just kind of goes away or the country no longer exists. Short of that, you very likely will get your payment back with the interest. That's why they call that the risk-free rate, right? The 10-year Treasury rate is at 4.10%. Um, this is lower than the long-term average. Okay, that's fine. The 10-year Treasury rate is the yield received for investing in a U.S. government-issued Treasury security that has a maturity of 10 years. The 10-year Treasury rate is included in the longer end of the yield curve. Many analysts will use the 10-year yield as the quote-unquote risk-free rate when valuing the markets or an individual security. Historically, the 10-year Treasury rate reached 15.81% in 81, et cetera. So just showing you that, there were some times in the past where the 10-year rate was much higher. Of course, there's times when it was much lower, but right now we're using 4.1% because that's what it is currently. And then the other component to this is going to be what's referred to as the market risk premium. And the market risk premium is the amount of return you would want for holding market risk, right? So if I just bought like let's call it an S&P 500 or a cross section of assets that are kind of well balanced in a well balanced portfolio, I can expect a market risk premium of about 5.6%, right? That was 2020, but today's numbers I think is similar. 2022, 5.6% is what they're saying also. And this suggests that investors demand a slightly lower return for investments in the US right now, right? Relative to historical figures, okay? So now we get to our capital asset pricing model, right? And all of these kind of Greek letters and this fancy looking kind of equation is really basically an equation that has a risk-free rate plus beta times equity risk premium minus the risk-free rate. That's the gist of the model here. Here's written another way. The expected return, so same model, but just written a little bit differently. Expected return is equal to the risk-free rate plus the beta multiplied by the difference between the market risk premium minus the risk-free rate. Again, here you have the risk-free rate returns received from risk-free investments, most often provided by the 10-year Treasury yield. The beta is a measurement of volatility, okay? Like how volatile that security is compared to the broader market, like the S&P 500, okay? And then the equity risk premium is the incremental return received from investing in a market S&P 500 above the risk-free rate, okay? So put it all together, I have NIO, Ford, and I think Tesla in here just for the conversation, right? So the risk-free rates and the market risk premiums are all the same. The only difference here is my beta. When I run the equation, I see that NIO's expected return is 7.1%, Ford is 6.2, and Tesla's is 7.6. And this is a reflection of how much risk, right, or how much beta or how much volatility is in that particular asset. So with this particular look, you can see that NIO is 7.1, which is, I expect a higher return for NIO relative to Ford, right? But it's slightly lower relative to Tesla. Tesla has a higher beta, which means that they have more volatility versus the average market return. There can be many reasons for that, but anyway, so this gives you a framework of starting to think about how my particular security is behaving in the market and what my expected return could be. Up here, they have this thing called KE. Here they have expected return. So it depends on your perspective, right? Expected returns from the investor's perspective. So I'm putting the money in, I expect a certain return. So my expected return is, 7.1%. KE is the cost of equity, and this is from the company's perspective. So when NIO is going to the public market to sell more shares of NIO to the market, it costs them, quote unquote, cost them 7.1%. So if they lend, or if they, excuse me, if they issue a stock, right, they expect to try to, they are expected to kind of make, based on the analyst's estimate, at least a 7.1% return on that investment for those investors. So just different perspectives in terms of what those are. Now, again, this is one piece of the big puzzle, because you'd have to go also into the, into the cost of debt, weighted average cost of capital, um, and some other views, including some portfolio theory, to have you to really understand whether or not an individual investor should continue to hold on to NIO. It has to be put into the context of your overall portfolio and how you're thinking about, these different assets that you're holding in your portfolio, how they behave and work together. And I think I'll do another video to follow up on this. All right, thank you.